So today we're talking about life insurance, and there are basically two basic types of life insurance. The first kind is term insurance. So term comes in a couple different systems. I'm just going to be again generic to talk about it. So term insurance is oftentimes through an employer. So the reason that's only term is because it's only on the term of when you're working at the employer. So if you leave the employer, you don't have the insurance anymore. The second term is term for a period of time. So that period of time could be a 20-year term or a 10-year term or even a 30-year term. And all that means is you pay a certain dollar amount every month or every year for that period of time. But once that term has expired, it either goes away or it becomes exponentially more expensive. And when I say more expensive, like almost no one would continue to pay for term insurance after that term has expired. So if you took a 30-year term and you took it out at your age 20, by the time you're 50, at 20, you may have been paying $20 a month. And at 51, which means it's after the 30-year term, you might be paying $394. Like that's how much difference it is. It's crazy. I just made those numbers up, but I'm not exaggerating. It's wildly expensive. So those are the two types of insurance that people have that are very inexpensive. With your employer, oftentimes they'll allow you to buy more insurance through them. We will look at that. The thing with lots of our clients, one of the things to consider is whenever you buy it through the employer, there's usually, not always, but usually a situation where you don't have to go through underwriting. So if you are not very healthy, that's extremely favorable because they are pooling either all the people at that business together and bringing them under one occupational average class, or they're even going even bigger. Like they're going to everybody in a certain area of the country, a certain state, a certain jurisdiction, or maybe across the whole country, and they're blending it average. So if you have diabetes and other situations and you can get insurance through your employer and then they offer you to buy more, we might say that makes a ton of sense. On the other hand, if you're a triathlete and you're any age, you probably would go through underwriting and be able to buy it on your own at a far less cost. So that's the basics of term. One of the things that is available now with a lot of companies is you can be converted to permanent. And then permanent, if I was going to say that there's one thing that people say all the time, people say, oh, I don't have term, I have whole life. So of the kinds of permanent life insurance there are, whole life is one. It is tied in with interest rates. So as interest rates are a little bit higher now, it's a little bit better than it was. For the previous, say, 20 years, not so good because tied with interest rates. And as interest rates are really low, just like the bank interest rates were really low, they weren't paying you a lot of money on the money inside. So all of these run with a very basic comparable situation. In this situation, you put money in, part of the money comes out to pay the cost of insurance, and then the rest of it goes down in to this bucket. So when I say interest rates, the money in this bucket that's left, so we're not talking about term, we're talking about the whole life here. If you're talking about where this money is invested, it is invested in something tied with interest rates. So that's what whole life looks like. The next version that was created was universal life. That's tied in with the company's investments. So whatever company you're invested in, a couple of the companies we use a lot, Ameritas Life, Midland Life, we have historically used AIG. We're under a banner where we've got about 60 companies that we use We don't use all 60 all the time. They have certain niche things that they work with, but the universal life is in the investment bucket of the insurance company. So this money here is invested kind of in the insurance company that has historically done a little bit better than interest rates. The next invention was variable universal life. Variable, it's kind of like your 401k. It is not a 401k, but the money is invested much like it. So it goes into the stock market. What goes on with the stock market? Here's your pie chart. We know it can go up by 40% some years. The bigger disadvantage when the year it goes down 40%. Here's something I don't love about these. I think all of these could have a place. The biggest disadvantage of this is I don't like the variable. For my insurance, I want safe, I want consistent, I want predictable. So what I don't want is a client having a situation where if the stock market gets kicked in the tail and the money goes way down, so this money that's in here, which is helping to pay for the life insurance policy, goes way down, and then they get a notice saying, hey, you have to write a check. I like predictability. I like consistency. I do not like surprises, as you might imagine. So this is the one policy that has the most surprises. It could surprise you to the good. It could surprise you to the bad. The version that we use the most now is called an indexed universal life. Or an IUL. Here's the difference. It seems like that UL, but instead of being tied to the company's investments, it is tied to the stock market, but they take the edges off. They buy options on the stock market. So in a good year, you might be positive, let's say 8%, but in a bad year, the worst you could do is 0. So I like conceptually, we're putting guardrails on the variable universal life, or we're adding a little extra upside to the universal life. And we still, inside of that, have a predictable bucket that's tied in with interest rates. If we want to, we can allocate to that. So this is the basics of life insurance from the term, which for a young person, has a family, needs more insurance, pretty fantastic offering. Good, affordable way to get into it. For somebody later in their years, once we get to 50, which I'm now in my 50s, it starts to get a lot more expensive. But the thing that happens is you'd really like, if you've paid all this time, you'd really like to have it when you die, because that's the biggest benefit. The other accessory, which is new in the last 10 years or so, is that oftentimes many of the policies that we're using these days, we are able to use not just for a death benefit, which is what life insurance has always been known for, but it can be used for long-term care. So I'm going to share that in the green here. But this long-term care means that they're going to potentially take the death benefit and it can be paid out in advance to your death for some kind of care needs. So all the policies have different nuances to them. But the biggest thing I would say is if your policy does not have a provision like this, it is definitely worth looking into. Because people are living longer, the cost of insurance is oftentimes no higher and sometimes actually lower than what you already have. So my 62-year-old saying, oh, I would never be able to get insurance now. It's going to be too expensive, but I have this other insurance policy. Well, you're already paying the expensive part because you're 62. Insurance rates haven't gone up. They've actually gone down. And now we have a new provision, which would mean if we had a death benefit of $1 million, we could pull on that $1 million to pay for someone, an aide to come to our home, or for us, if we needed to go into a care facility or have someone helping us, whether it's a personal friend, a nurse, an organization, or whatever it is, or even making changes and modifications to a house to keep us at that house. So a nice pool of money to be able to do that. So this is just an educational video. If you have any questions, please reach out to us. We would love to help.